Hello, everyone. Thank you for attending. This is Siwin Yi, and my guest host is Mr. Richard Advani from Guarantee Rate Mortgage. Welcome, Richard, and thank you for your time. I know you're very busy doing investment loans, all types of different mortgage loans, many buyers out there. So we have a lot of great things to cover. Before I begin, please smash the like button and subscribe to my YouTube channel, and also join my network. Put your email into my website below so you can become a free member of our real estate investment community. Let's go over mortgage news daily. As you can see, today's rate is 6.18%. It went up 0.02 basis point. We all know that the mortgage rate follows the 10-year treasury. Let's look at one more thing I want to go over. The job report just came out, and the Federal Reserve, they look at the job report. If the job is weaker, they may not want to do any more rate hikes. How do you tie in the job report just came out this morning in relationship to what's going on with the volatility of the mortgage rate? Because the Fed look at the CPI, the inflation factor, and the job report before they will make some of those interest rate decisions. So what are your thoughts about the 10-year mortgage rate, the treasury, and the job report, and the CPI? Because they all have a tie into it to the mortgage rate. What are your thoughts on that?
Fortunately and unfortunately, the jobs report came in today stronger than expected, which rates as of yesterday and today have pretty much hit one-year lows. I was expecting the jobs report to come in not quite as good, which would have been good for the 10-year treasury bond in terms of it going down, and that would have been good for mortgage rates. But the fact that the jobs report still came in pretty good, I think in the short term, in the next couple of weeks, rates are going to move up from where they are today, mortgage rates. As we're on this call, if you guys see me working in the background, I'm actually working to lock a bunch of loans that we've been waiting on because the market has been trending downwards. I think there's a good chance of them moving upwards marginally to mediumly in the next couple of weeks. I'm trying to secure every single one I can today, April 7th, because I think they're going to move up a little in the short term. Now, I think CPI data comes out next week, and we'll see how the next couple months look. But based on the jobs report, I think the Fed's probably willing to increase their rates a quarter at the next meeting as well, and then hopefully level off after that. But there's so many variables right now. Things were looking quite the opposite until SVB happened. Because of that, the treasuries dropped and our rates dropped significantly. But it gets back to the point is, if you're on the fence, get off the fence. And the next 4 days is probably going to be a really unique opportunity in the last year in terms of rates, especially today. If you're on the fence, get off the fence, because you do have an opportunity to capture rates that are 1% lower than they were a month ago. It's a pretty sharp difference.
Exactly. As I continue with this mortgage news daily, let me go over this yellow highlighted I just did. It says, officially known as the quote, the employment situation, end quote. The job report is the single and most important piece of the scheduled economic data interest rate on any given month. During times of high inflation, it can share the crown with the consumer price index, CPI, but that typically just means we have two really important reports to close proximity. CPI is next Tuesday, rather than the one dominating the other. So possibly breaking the average 30-year fixed rate into the high 5% range for flawless scenario. And then he says, if the job report is stronger than expected, and inflation is higher, which is a CPI measures inflation, rates would almost certainly bounce at the current lows and head back up to 7%. So what do you make of this several paragraphs?
It seconds what I just said right before you going through the article. And that's funny, I didn't even read the article, but yeah, we're at record lows right now, and there's a lot of volatility ahead. And there's a good chance, depending on how these reports come out, that we will move up from these temporary lows we've experienced. Kudos to all of you that have taken advantage of it, that have been working with us the last 2 or 3 weeks if things have moved down. For those who haven't, hopefully this video gets out soon, because by the time a lot of you hear this, rates may have already moved back up.
There's some experts, or in the next 12 to 24 months, they are saying, those economists, either you and I or such, we cannot predict the future. We have no crystal ball, nothing like that. But one would reasonably conclude that you and I, in the next 1 to 2 years, perhaps the mortgage interest rate going to be around, I think, around somewhere in a range of 5.75% to 7.25%. That is just my prediction of the volatility of the mortgage rate. Yeah, so this is to me, this is the new normal, Richard. New normal means For any people in this housing market thinks that we're gonna go down below the mid 5%, they may be unrealistic. For anybody that project that we can have a higher than 7.25 mortgage rate in the next couple of years, they are also being unrealistic on the doom and gloom side of it. Given this price volatility range in the next 1 to 2 years, no one knows for sure. Again, 5.75% mortgage rate, 30-year fixed to 7.25. Assuming you and I agree this is the volatility range in the next 1 to 2 years, let's take a step back. Let's discuss the two categories of buyers: primary homeowners, owner-occupied buyers. My conclusion is, for that person, if they could afford to buy a home, if they want to invest to stay at the home for 7 to 10 and they feel comfortable about their neighborhood and the house that they're buying, there's no reason why they should not pull the trigger. Now, the other category of buyers, that something that you and I are focused on, this is our business, by the way. We help real estate investors to buy investment properties. So let's talk more about that. As I go over the several thousand of members in my real estate investment club, too many of them are still on the sideline. We're not only talking about newbies. I understand the newbie real estate investors that are trying to buy their first rental properties, they're not going to come back because they are so fearful. They're so uninformed and a lack of courage, whatever. They just don't get into their lack of informed decision. They can fall by their wayside. They were never going to come back. But some of the experienced investors that I worked with over the past few years, they have purchased one or more rental properties. Most of them in the past 9 months to a year, they are also on the sideline. Why? You do not know. You and I agree, we don't need to talk about real estate crash anymore because it ain't crashing based on the low inventory and all that. Economics 101. For the remaining few savvy real estate investors that you and I work with, the mom and pop investors that already purchased 1 or 2 rental homes, there's really no reason why for them to stay continue to be on the sideline. Cash flow properties are still available in many markets, like in the Midwest. The Midwest doing well. The Florida markets, the suburban path of growth market doing well. The Texas suburban market, Alabama, the market that we present, are doing very well. You can cash flow with 25% down payment. The cash flow is not that high, but still cash flow. That's a good starting point for any savvy investors, mom and pop investors. You and I work with Richard. There's no reason why for them to stick in the sideline because the next 2 years is not going to change, except the prices or homes may go up. So the mortgage rate, given what it is, that's it. That's a new normal. 5.75% to 7.25%. For risk investors, either pull the trigger now, invest for the long term, 10 years or more, whatever, or stay in the sideline. If they stay in the sideline, they're not going to reap any kind of benefits because they are foregoing the potential to get cash flow over time, increasing. They're foregoing the opportunity by buying now, buying and wait instead of wait to buy. They get multiple benefits like tax benefits and equity growth over time, rental income increase, and debt pay down by their tenants. Once again, Richard, what are your thoughts about what I just said? What else can we say that we have not said already? You and I talk about it so many times, multiple times, trying to motivate our few remaining investors to get off the sideline and do this. Because right now, the inventory is so lacking, and right now there's a little competition. Things are it's going to get better. We can see a mini boom. We're seeing a mini bidding wars out there right now already on the entry-level homes, many markets. So what are your big picture take as we conclude this?
I support everything you said, and it's what we talk about on every single one, right? Which is people getting off the fence. And every webinar that we've done since the beginning webinar, real estate has been resilient and it's been recession proof. And if you remember, I think we had a graph, 6 months ago that we had on here that showed the kind of flow of real estate with every recession. And besides the 2008 kind of real estate driven crash, mortgage driven crash, real estate had stayed steady or gone up every recession, right? If you look at the graph of real estate over the last whatever term you want, right? You look at 20 years, 50 years, 100 years, 1,000 years, always does this. And why? It's always based on supply and demand. And there's always going to be more demand than supply of housing. Why? I think it's common sense. Population keeps increasing. Get away from all the noise of rates are doing this, or the Fed's doing this, or we're in a recession, or whatever the noise is, the flavor of the day is. And if you're looking long term, which is the only reason I invest in real estate, which is long term, to not invest in real estate based on what we just discussed, the supply and demand, there's always going to be more demand than supply. Population's increasing, people living longer than they ever have, and the land's not growing. All these people have to go somewhere. It's always going to be a supply and demand thing. And you're always going to see real estate doing that for the rest of human civilization. Forget statistics, forget noise, forget everything else. Anyone can understand what I just said. It's common sense. And based on hearing that common sense, you still want to sit on the sidelines, then I don't know what to tell you more for the rest of us.
Human nature is very weird. Behaviors, emotions cannot overcome real factual information. That's how it is.